Hello everyone. At this time we're going to work through the comprehensive problem at the end of Chapter 4. And the interesting thing that's introduced in Chapter 4 is what's called a non-controlling interest. In the old days that was called a minority interest, and simply that minority being the opposite of majority, majority being a 51% ownership, so a minority was anything less than that majority. So the nomenclature has changed now, and so we're going to consistently call it the non-controlling interest. And so in this problem, they introduce the concept of a non-controlling interest. In this case, it's going to be 20%. Now, what I want you to do before we get into the actual working of the problem is there's a PDF file that is in Blackboard, and I want you to print that out or have it on screen. It's probably easier just to print it out, and that way you can make some notes on it. And I'm not going to waste our time necessarily reading through everything, because once you print it and read it, then you can see what we're going to do. But so what I've got on screen right now is the PDF. So go ahead and make sure you're prepared. And at this time, I'm going to close this out. By the time you then get into the rest of the video where we're going to work an Excel spreadsheet problem, or work this problem using Excel, then you'll be familiar with some of the facts, and which you can see the facts are on your screen. So let's get out of the PDF, and now I'm going to go ahead and bring up the problem itself. Now I've got excuse me here, I've got both a blank that I'm going to fill out the numbers and kind of talk through the steps, and of course I've got the completed at the end of this whole problem. But let's first do, this is a template that I set up for you to kind of explain what's going on with the allocation of the fair value. Now in the problem, they're buying an 80% interest. And one thing I do like about this problem is the fact that the parent company, in this case they call it father company, and they're buying son company. These are all cute little ways to use their naming convention, but they're buying an 80% interest, but they're using the cost method to account for the investment as they go through time. The reason I know that, and you should know this too, is they're giving you the trial balance data, and you can see in the problem as of December 31st, 2013, when in fact they bought the company, or bought the 80% share of the company in 2009. So they've gone through time, and the balance in the investment account is the same balance as what they paid when they bought the 80%, which is $425,000. So, and just so you know, in practice, that's typically what happens: is you carry that investment at cost, as opposed when you're doing a consolidation. Say in this case we own 80%, just keep it at cost and keep things simple, and then do your consolidation every quarter, and you'll have all the data that you need, and you'll be building legacy files as you go through time. So anyhow, this is what we're doing here. We're going to set up, I want to show you how they allocated that purchase price. So the price that they paid was $425 grand. That's what you see in the investment account on the balance sheet. They also tell you a little fact that the fair market value of the non-controlling interest, that's hence you see the NCI abbreviation, is $102,500. Now what that does mathematically is the total assigned value then is $527,500. They tell you the net book value is $400,000 given in the problem, and that $400 was split between $100,000 of common stock and $300,000 of retained earnings. So then you can see easily that the excess of the acquisition value over the net book value is $127,500. But what you now have to do is say, how do I split that between the parent and the non-controlling interest? Because the math doesn't, what you want to do is say, is there any goodwill that I'll be assigning to this non-controlling interest over here? Now these were pretty straightforward numbers in terms of the net book value, which just taking 80%, you can see in the formula here, 0.8 times the 400,000, and then this is 0.2. And then also on the value, it's the same split. well, excuse me, it's not the same split because you're taking the 102,500 and dropping that straight in here, and the 425 is exactly what was paid by the parents. So then that gets you this total excess. So we've allocated the 127,500 between parent and non-controlling interest. Now look what happens when we say this again in your problem. They give you the identified assets. In this case, we've got land, buildings, equipment, and a royalty agreement that are all listed out there, and then these amounts are given to you as far as how those captions on your balance sheet are undervalued. And so all we're then going to do is take the 112,500 and assign it to these various assets. And of course, you see that the sum. You look down here at my formula bar, and you can see the sum is 112,500. And then, you know, if we had an excess of 127,500 minus the 112,500, then our goodwill is going to be 15,000. But this is what I want you to see: is we're going to split these various undervalued assets by the respective ownership percentages. So you can see the 50,000 times 80% is 40,000. And then to make up the total 50,000, I'm going to drop 10,000 over here in non-controlling interest. So all these amounts are the same formula up here. And sure enough, we then are able to allocate the entire 22,500 for our non-controlling interest. All that is allocated to these specific assets. So then the goodwill, if I take my my parent company share, which are the sum of these numbers here, the 90,000, I still have 105,000, which is my excess of what I spent over the book value, that 80% book value. And so then I've got the $15,000 of goodwill. So this is a little cheat sheet you might want to keep handy as we go forward, in how you would allocate then goodwill between parent and non-controlling interest. Okay, and then down here at the bottom is another thing you're going to have to do pretty much with any consolidation, is you're going to have to now take care of this, the excess amortization that you need to account for in your consolidation worksheet. And again, these entries, it makes it nice and clean, I think, if you don't do these entries in your investment account and use this full equity method when you are the majority owner. I would rather, in practice, this is the way it is. Would rather just keep the investment at cost, and you can maintain all this data over here in a spreadsheet somewhere. But what we're doing now is saying that for these excess amounts, of course, you don't amortize land. Remember that from your your lower level accounting courses, and they give you the years of depreciation or amortization you need to use. And so these are our amounts. These are our amounts that will be depreciating the excess depreciation or amortization each year. And I've got the 4 years going here, so then I've accumulated that. So again, this is all just background information. I want you to see how these numbers are derived, and we're going to use this then as we go forward into our consolidation, where we're going to do the actual worksheet. Okay? Okay, at this juncture, you should have open your the blank Excel spreadsheet. I'm providing you both the, you can see the completed tab down here at the bottom, but if what we want to do is have you work through the blank tab with me, and I'll explain where the entries are coming from. Now, what's different about this concept now that we've introduced in Chapter 4, the non-controlling interest, we still have our parent company in this column we're calling, which is called father, and then son, I called it SON, maybe I think it's SUN in the text, so not to be confused. But we'll have both side by sides. We'll juxtapose those trial balances, and you can see it's a full trial balance here with assets and liabilities. Assets equals liabilities plus equity for both entities. And then, as usual, we have the eliminations and adjustments column here that I just highlighted, and we have those, as debits and credits. Now, here's the difference, that we are adding a wrinkle to it. And you'll have this as a template then to work the problem on the test, and as well as your homework, is you've got a column now called non-controlling interest, as well as the consolidated totals. Now, just to peek ahead a little bit, let me flip over to the completed tab, and you're going to see that what's in this non-controlling interest column is we're going to have several entries or several items that we'll add together. I shouldn't say entries because again, you are not going to be making these as journal entries onto the general ledger. You're only doing this here on the spreadsheet when you're in practice. But look what happens. We've got the total of our non-controlling interest in this column here, and it's going to drop over in our equity section then to complete our balance sheet for the consolidated totals. So again, this is about as complicated as you're going to see things now that we've built up to Chapter 4. Is this new column called non-controlling interest, and then we'll see that as we go across, we have to our debits and credits. We have to have either an increasing or decreasing effect based on what kind of account we're talking about, and then we're going to end up either splitting something. Once we add the two numbers together and then take into account the debit or credit that needs to occur as part of our consolidation process, and then either split it between non-controlling interest and the consolidated total. So, and we'll see how that works as we go forward. So now we're going to flip to the blank section. The other thing I've done differently, and I am deviating a little bit from the book, but I want you to know as part of your learning, as long as you have your cross references, and you'll notice on the spreadsheet templates that I'm giving you, I've got these two columns here that I'm alternating here, and I've got these cross references. Now, the book goes through a fairly regimented nomenclature on how they name these kinds of entries, and frankly I don't care if you use that exact nomenclature as long as you put references on your debits and credits, and that's what helps you keep track of whether your debits equal your credits as you go through the consolidation process. And then what I'll ask you to do too is define or describe what each one of those are doing. So let's just start hacking through this, and I'll explain as we go forward. So remember, this was a cost. The $425,000 was what father company paid for the 80% interest. So the very first thing we'll want to do, and I went ahead and left all my cross references in from the completed column, but we'll want to get rid of that equity piece that relates to the 80% share. Now remember, they had $100,000 of common stock, so there's going to be an $80,000 credit on the investment account for that common stock, and now I'm going to have to then also take care of that down here in my equity section, and there you can see that 100,000. So I'll have the $80,000 debit that will go against help eliminate that 100,000. Okay, now remember too, on retained earnings that was 300,000, and so on my second I use as basically as my just cheat sheet for shareholders' equity, but that's going to be 240,000, which takes care of the 80%. And I'll need to then also let me get up here to retained earnings, where I have retained earnings showing. Right there it is. Now retained earnings, this is 480,000. This is as of December 31, 2013. Remember, we bought this investment back in 2009, so we're going to eliminate that portion, that original amount that relates to our 80% share. Now, the other thing I need to do is take care of the non-controlling interest piece. Okay, and remember that's going to be the $20,000. So the first thing I can do, I've got this labeled S4, is let me just show you that is the 20,000 here that we'll credit, or excuse me, we'll be debiting. And so now the combined is 100,000, and I have now on my consolidation I've eliminated the common stock. Okay, so that's the 20,000 there on the non-controlling interest. Now where do we go with that? Okay, that is going to be one of our entries over here on this non-controlling interest section. Okay, I notice I've added this in. I had nothing in my my separate trial balances of the two companies, but I'm certainly going to need is to put that that $20,000 for the non-controlling interest share of the common stock. Now, as you might guess, I also have to do that for their share of the owner's equity. So I'll go ahead and take that 60,000. Again, that's going to be 20% of the $300,000 beginning retained earnings that we had. So I'll be putting the $60,000 up here as my debit. Again, what I'm trying to do is, in a consolidated basis, I'm going to eliminate what's in this the acquired company. And you can see what I've done then is I've taken it against this investment account that I had on my books of $425,000, but I've also gone down here and allocated those equity accounts to the non-controlling interest. Okay, so this is different. These rows here are different from your prior spreadsheet. Let me go ahead and grab. Sorry about that. All of this, we're going to roll it forward and say what is the non-controlling interest balance that will drop into our final consolidated presentation. Moving along in our consolidation, the next step we need to do is take care of these identifiable undervalued assets that existed at the time we bought the business. And you'll see that we're going to take $112,500 and go to these various accounts, and we've got then $15,000 of goodwill. As we do the exercise in the spreadsheet, you're going to see how then we'll split this between controlling and non-controlling interests. So let's go through those entries. I've labeled them A1 and A2 in my my cross-referencing here, and that's a little bit different from what the book says, but as long as I'm keeping track of what I'm doing, then I'm good to go. So the first thing let's go through each of the captions and assign those values. So we had $20,000 going to building, and the equipment was $12,500, and again I'm getting these straight off the problem, and they're also in the template that you have down here in this fair value split. And we had the $50,000 identified to land, and then on the royalty agreement that previously was not on the books, we said that is worth $30,000 at the time we bought the business, so we have to set that up. Now at this point, I'm going to look at the sum of those as the $112,500. Remember, that's this amount here. That's the total of all of them. Now we're going to have to split that between the parent company and the non-controlling interest. So the $90,000 obviously went to our investment account when we bought this 80% share. So we've got to credit the investment for $90,000. Now I'm not in balance, okay? Because why am I not? Is because the amount that is attributable to the non-controlling interest is $22,500. I need to put that over here in my non-controlling interest section. So we'll put the 22,500, and you'll see that causes us to be in balance here on our consolidating entries. And again, what I'm doing here is I'm building an amount you're going to see this when I put my my formula in here. You'll see how we're going to have a section called non-controlling interest or total here. Okay, so one more thing to do is, and it's kind of neat that you can see if I take my investment account and I've credited for these amounts, I'm still left with $15,000. Well, what is that $15,000? Well, we know from this spreadsheet here that $15,000 is my goodwill. You can see it on screen there. So let's get rid of out of my investment the $15,000, and then let's show it doing my cross-reference. A2 is what I'm using here, and let's establish goodwill on the consolidated books, and we're good to go with that. Okay, and check to see our debits are equaling our credits as we go through. That's good. Now, one more thing to do that'd be a little bit tedious, but we need to handle all these. I labeled them with an E, E1 and E2. And what we're doing with that is E standing for excess, expense, amortization, that we need to take care of that. Now we've been several years down the road since we bought this 80% share, so there's a little catching up to do, and that's why I did this this calculation down here at the bottom. I'm looking at $2,500 on the buildings, $2,500 on equipment, $1,500 per year on the royalty agreement. But then I also did my accumulation. I'm going from 2009. We bought the company, bought the 80% stock in January 1st of 2009. So basically I have 4 years, 2009, 2010, 2011, and 2012. Excuse me, I've got more than that. I'm going to be taking 5 years. So that I had to this is my catch up. I'm sorry, I'm glad I kind of made that mistake. These are getting me from 2009 up through 2012, and then these are the entries that I will be making on my consolidation spreadsheet for 2013. So Um, let's first handle these catch-up amounts over in our consolidation spreadsheet. Now, so then for E1, excuse me, I'll do these with E2 will be our consolidation catch-ups, okay? So we had $10,000 to catch up on the buildings, and on the equipment we had $10,000. Again, these are taking us from 2009 to get us all the way up to the beginning of 2013. And then we had $6,000 on the royalty agreement for E2. Now, after I've made all of those entries to catch up my amortization for those prior years, what I need to do is take that $26,000 from my beginning of year retained earnings. So that will be a debit here of 26,000. And again, all of that there's my 26,000 right there. It's the 2009 to the beginning of 2013. It's all that excess amortization that I would have had on my books had I had these items recorded at fair value. Now, of course, I didn't put them on my books. What I'm doing is I'm putting them on my consolidation worksheet right here as an adjusting entry, and so it's going to go as a debit against this retained earnings balance. Because remember, retained earnings is closed every year, and or your revenue and expenses are closed to retained earnings every year, so they're receiving the effect of that expense, that amortization that goes on. Okay, so that's the reason we're debiting the retained earnings account. So let's do a quick gut check on our debits and credits, and we're good to go. We're in balance there. Now let's take care of the current year excess amortization that needs to happen, which I've detailed for you here. Basically, we have $5,000 of depreciation and $1,500 of amortization. So when I head over to my worksheet, amortization we said was $1,500, and my two $2,500 amounts added together would be $5,000 on the depreciation expense. So I've got that right there. And then also, obviously, they will go as a credit because I'm showing buildings, equipment, and my royalty agreement, showing them net, basically net meaning the cost minus accumulated depreciation. So I'll need to drop in the 2,500 here, drop in the 2,500 for the equipment or for the building, and then drop in the $1,500 on the royalty. Okay. Now, those credits are against my asset. Now you can see my debits and credits are equal, which life is still good, and those debits, the excess expense is going into my eliminations or my adjustments. It will be shown in the income statement here, and you can see it cross-foots. Now, there's a couple other small things to do. They did mention that the dividend, there was a dividend paid from the subsidiary to the parent. So you can see right there that $16,000 of dividend income, because they are not using the equity method to account for this investment, they're going to show it then basically as an income account. So we need, as part of our elimination, we need to get rid of that. So I'll have a debit for $16,000, and now where is my credit on that $16,000? Well, it's not going to be, investment. And I just look down here, and I can see I have a dividends paid account on the books of Sun, the subsidiary. Now, what I am going to do while I'm at it is go ahead and show a $4,000 allocation, because again, I only own 80% of the company. So the $16,000 is 80% of the $20,000 of dividends. So there needs to be $4,000 going to the non-controlling interests, and of course, the only thing I'll show as a consolidated group, and I'm father, and I'm going to be reporting this consolidation to the SEC. I only want to show the dividends that I pay to the outside world, and so you can see then I've got $90,000 on my consolidation. And we'll handle this $4,000 in the non-controlling interest in just one second. Now, the next thing I want you to look over here in this section. I've detailed out this net income to the non-controlling interest, NCI. So what was Sun's net income pre-consolidation? It was $170,000. You can see where I'm getting that number right here. Now, there was the $6,500 of necessary expense adjustments, which are the sum of these two. and then that brings them down to 163,500. Now, the non-controlling interest group is entitled to 20% of that. So if I take, you can see my formula here, I'm going to take the 20% times the 163,500, and I get $32,700. So what I want to do then is take 32,700 and allocate that. I'm a little bit off in my I don't know why that's bolded there, but I'll allocate that to my non-controlling interest. And then what I want to do, excuse me, I put that on the wrong line. That's why I was off. Apologize about that. Let's take that out of there and put it here. And now this number needs to be actually a negative amount. So, not to confuse you on what's gone on here, but if I look at my consolidated amounts, okay, and basically I'm cross-footing and then taking into account the effect of any debits or credits, so you can see where these numbers are coming from. You just kind of scan across with your eyes and you can see where all that comes from. There's no dividend income because I had to eliminate that. So now on a consolidated basis, 393,500, but I did my little adjustment over here to say how much is appropriated or allocated to the non-controlling interest, and then that's why I get 360,800 for my consolidated reporting. Now, look at non-controlling interest, and let's see what's going on there. I've got 32,700 of net income allocated to them. There's $4,000 of dividends that will be a reduction of basically their interest. You know, and there's one more thing before I jump into this right side over here. There was a minor fact, and I've labeled it with a P, and they said that in your problem that there was an intercompany receivable and payable, and that amount was $20,000. So one thing you need to realize that is you do not, you would be inflating your assets and your liabilities respectively if you show these intercompany amounts. So those are always eliminated in consolidation. And much of the time, and we're going to get into this with chapters 5 and 6, is you're having these intercompany transactions that are part of the day-to-day operations, because many times there's vertical integration where a parent owns subsidiaries because they're supplying stuff, and so there's all this transfer pricing. And so intercompanies are a huge deal, and as opposed to just these, you know, say a simple intercompany loan where one company has a liability, the other company has a receivable, and they're basically reciprocals of each other. But you can have just thousands upon thousands of transactions running through intercompany receivables and payables. But the cool thing is, one, it's eliminated. Those intercompany receivables and payables are eliminated against each other in consolidation. As you can see here, this $20,000 in basically our current assets, and then down here in our liabilities. Those are the two elimination amounts. And let's double check, make sure, yeah, debits and credits are still good to go. Got a little reference issue here I need to deal with. But anyway, on the intercompanies, you do have to keep track of that, and I think I said in a previous video lecture is you basically don't go home at night until every day when those things are verified, and you just don't let anybody hit intercompanies without notifying the counterparty to that entry, and that basically keeps it clean. So let's see what we're doing here. We're all looking pretty good on our consolidated amounts, the end of year retained earnings. And let's go down and make sure we're good. Our investment is eliminated. I'm going to add these up. You can see down here in my formula bar, it's 425,000, so I'm at zero on my investment. And I think this was just a carry forward in our template. We really don't even need that line item right now. So, and then our buildings and equipment, land, all those are now showing at market value. We've reduced the prior year depreciation, excess depreciation and amortization. Those are good to go. Total assets at $2,930,000. And now what we need to do on this consolidation, I'm not sure why I've got a problem here, because basically I'm going to do a formula, and I want to add, if I can spell, I'm going to add the impacts here for my non-controlling interest. Okay. Of 102,500, and then what I'll have, Oh, I know what I did wrong is I need to put this formula here. I apologize for that. I need to have these amounts just above. And then what we're going to have is a non-controlling interest total that if I take everything, so I've got my net income portion. So let me show you how we're going to do this. I'll do an equals and I'll take my net income that's attributable. Now, I want to deduct net income, deduct dividends paid, and I will also then add the equity amounts that we have here, and then we'll have 131,200 that's attributable, and so I'm just going to bring that straight over to my consolidation. And then now, I have a happy dance because I can see that my total assets are equal to total liabilities and equity. And I've got this, let me put some fancy coloring on it, this amount here, the non-controlling interest. This is what's different from your prior chapters. This is what Chapter 4 is all about. Okay? So at this point, we're good to go, and you can see the completed amounts over here. And we've accounted for every necessary entry, and we're tying out to what we need to tie out, and life is good. Thank you.